It's exactly 11 a.m. Central Time, and we are here joined today with our viewers from Facebook, StreamYard, and even YouTube and other platforms as well. It's another week full of learnings and events here in Real Estate IQ. And I know that a lot of our clients and social media followers are also looking forward to our events every week. That is why today we are again hearing your requests and putting up this event together with our special guests that we will meet later on. But before that, I would like to introduce myself. I am Sophia, your host from Real Estate IQ. I would like to remind everyone before we start that if you want to get a recording of this event, make sure that you have registered or that you will register through the StreamYard link that we will provide so that the recording of the event will be emailed to you right after this. All right, so again, to kickstart this event, again, I am Sophia, your host from Real Estate IQ. We are a one stop solution to your real estate needs, from customized data to events to real estate education. We all have it here. We are your partner in winning real estate deals through automation, skip tracing, and deal finding. All right, so that's a bit about our company. Moving on to the highlight of our event, our speaker for today, we will be joined. So for our viewers out there, maybe you could comment, you could share where you guys are from, and of course, help me welcome our two esteemed guests for today, because we will be joined by Kayla Pelland, the Senior Vice President of RealtyCo Partners, the real estate division of a Texas-based family office specializing in investor funding solutions and asset management. Kayla has a background as the president of a residential property management firm and has launched, scaled, and sold several other businesses, joining RealtyCo. Prior to joining RealtyCo, she was a licensed realtor in Canada, focusing on investment properties while managing her own buy and hold portfolio. Kayla has driven key initiatives in different fields, and her goal is to make real estate investing accessible, helping others achieve financial freedom, and leading RealtyCo through its vision of being a vehicle for success. All right, we are joined by Kayla. And of course, we will also be joined today by Ashley Thurman, the team lead account manager and DSCR specialist at FlipCo Financial. Ashley comes with a rich background in fix and flip loans and a deep understanding of the nuances surrounding DSCR loans. She's dedicated to empowering her clients with the tools they need to succeed in today's competitive market. Her ultimate goal is to expand knowledge about DSCR loans by illustrating how these loans can finance not only traditional rental properties but also fuel renovation projects, and she aims also to enhance clients' understanding and enable them to maximize their investments. All right, with both of our guests today, I'm sure you guys are all excited. We are excited, and they are also excited to share their insights, tools, and best practices to help others navigate this complex landscape and realize their own success stories. So, hello, Kayla. Hello, Ashley. Welcome to Real Estate IQ.
Good morning.
All right. So, you may proceed with your slides. I will stop sharing my screen.
Perfect. Is my screen sharing yet?
I don't see it, Kayla.
Okay. Let's see here. There we go. Do you see it yet, Ashley? Anybody else?
Not yet. Give it a second because it started to load a second ago.
Here we go. How about now?
It's loading. There we go.
All right, let's kick off. So as our esteemed host mentioned, Ashley and I are both FlipCo Financial. I do run the real estate division of our family office. Ashley is one of our specialists in the FlipCo division, which does focus on hard money. And most specifically, she does bring to the table a wealth of knowledge in the DSCR space. So today we're going to go through how to use the BRRRR strategy to build a buy and hold portfolio. So let's just kick that off. Okay. Give me 1 second. Do you see my full screen or just part of it? Or is it just the slide deck?
It's just the slide deck.
Okay, bear with me. Somebody popped into the office to give me a heads up. So let me see if I can figure that out. Is that better where you can see both of us as well still? Or just the slide deck?
Just the slide deck. I think there's a presentation button down at the bottom right-hand side of the screen that you can click. So it's next to like your Zoom and stuff. It looks like a little presentation stand.
Yeah, I just have the screen sharing in there. So it may end up being just my, let's try that. Playing a picture, no. Sorry, guys. Is that better? Or is that still just the one screen?
Still just the one screen.
Okay, let's try this one more time. Bear with us.
We may not be tech savvy, but at least we're loan savvy.
This is very true. Do you know what I'm supposed to click in here? I'm being rescued, y'all. Bear with me for 1 second. Okay.
How do I exit? Sorry, your mouse.
Realtor.
So I see that we've got a couple of people that have commented. Someone's from South Lake. That's awesome. I live only about 40 minutes from South Lake in the North Texas area. Oh, we've got a Houstoner in here. I'm curious, while we're kind of like figuring out the technical difficulty presentation side, how many people who are joining us know what BRRRR actually is before the presentation? Sean, Fort Worth is really close to me as well. I love that area. You're right, Scarlett. That is correct. Does anybody know what DSCR is? Debt to income ratio. Yep, that's exactly. But do you know what the letters actually stand for DSCR? That's something we're also going to cover. I'm just curious. Debt service. Yes, but there's two other letters. Yep, Sean got it. Debt service coverage ratio. And we'll tell you exactly today what that means and how to apply it to the properties that you find for fix and flip, and then flipping it into a rental. So I see we've got Houston, South Lake, and Fort Worth on here. Is there anybody else from a different area that they want to mention? I'm curious also, how many watchers do we have that have actually heard of FlipCo Financial before this presentation? Seattle, Las Vegas. Oh, that's awesome. Midterm rental. That's pretty cool.
Thanks for bearing with us, guys. We're still here. I'm just uploading the slides into the presentation so that we'll be able to see us and the slides at the same time. Thanks, Ashley.
Yep. Bastrop, Texas. I've been there a time or two. Very pretty country. Short-term rental in Las Vegas. Those are becoming more popular in Vegas. Ah, we have a presentation.
Thank you so much. Okay, we're back. I'm so sorry about the intermission. Shout out to Miss Alessandra Mora for saving us. Does that look okay on your screen, Mora? Does it make sense? Can't see me. Can't see you. Okay, good. Leave it like that. All right, let's kick it off, everybody. Apologies again for that. So we were already introduced, but again, my name is Kayla Pelland. I lead the real estate division here at RealtyCo Partners. Our real estate division does operate out of a family office in Houston, Texas. We really specialize in investor finance solutions. We also look at asset management, project management as well, but our claim to fame really has been the hard money and investor financing solutions that we bring to the table. Ashley, was there anything you wanted to add to your intro?
I'm just a really big specialist in DSCR rental. I actually did come to FlipCo from a DSCR wholesale company. So knowing DSCR like the back of my hand and how to make it work is really one of my specialties. And I'm happy to share all of those with our listeners.
Awesome. So FlipCo Financial, as we mentioned, was really founded on the backbone of trying to be transparent and bring something new to the market. We've been operating since the end of 2020, so still fairly new. One thing that really has set us apart and adding team members like Ashley has just made this more and more of a reality is that we've built our foundation from an investor's perspective. So our founder, our owner, none of us come from a traditional financing background. The majority of our team is made up of people who have either flipped properties, held properties, managed them, ran projects, been GCs in the past. And we've really brought that to our investors now in a common sense approach to helping them build financial wealth and independence through real estate. Today, we're going to run through the BRRRR strategy, and really look at the two main components of that. So I'll lead us through the first half, which covers how to use a fix and flip loan or hard money to acquire a property and do the buy and rehab portion of that. And then we'll hand it over to Ashley to walk us through how we would successfully DSCR that project, refinancing out of the hard money loan to hold it long-term and ultimately look to be able to build a portfolio of cash flowing assets. We've both are very excited and passionate about what we're talking about, but we don't want to be in an echo chamber just chatting with ourselves. So please feel free to interrupt, chime in. If Ashley or I catch questions coming through the chat, we'll definitely stop and address those. But feel free to make this as interactive as possible as we kind of work through. We want it to be beneficial for y'all, especially.
And we both really like to talk. So
don't let us go. So I think Ashley touched on this slide while y'all were waiting a little bit. And this is, again, what that BRRRR strategy stands for. So it's just an acronym for buy, rehab, rent, refinance, and repeat. And again, the goal is to be able to build a portfolio of rental properties. Again, some people will do this on a smaller scale and just acquire maybe one or two, but there's definitely people who have found financial freedom through real estate by following the strategies that we're going to be covering today. And again, these are the two pieces of that. So the hard money loan, for anybody who's not familiar with what hard money is, essentially what that is a loan that is, unlike traditional financing, requires lighter underwriting and is very asset based. That's the most important thing to understand about private money or hard money loans, is that the person underwriting or providing that financing is really looking to the asset to secure the property. With the DSCR piece, they're looking at debt service coverage. And so that has more to do, again, with the asset and the rental income than it does specifically with the individual. Of course, there's still underwriting guidelines on both pieces of this that look to the borrower or the guarantor to make sure that they can execute or properly manage this property. But we'll touch on that a little bit more specifically in terms of what expectations or guidelines that you should expect to have to follow when you're getting qualified for the hard money loan as well as the DSCR loan. Of course, always remembering that this is a two-part process. So if your ultimate exit strategy is to hold this property, even though the underwriting guidelines on the hard money or private money may be a little bit more lenient or easier to get into, in the back of your mind and your lender's mind, we're taking into consideration that exit strategy and wanting to make sure that you're going to qualify for that down the road. So just keep that in mind. It will sound very sexy when you hear that hard money doesn't check credit or necessarily have a full background check, but the DSCR piece will look to those things. And again, Ashley can touch on that more as we work through it because there's still solutions there. But I just want to make sure we're clear that you want to be considering the highest requirements available to successfully exit, even if that's not part of the hard money acquisition side. To work through this, we're going to use an example property. So if you guys want to kind of keep these figures in mind, we'll use this when we're showing a quote of the hard money loan. And then Ashley's using this same property when she's showing you how the DSCR would work. So if we have a property that we're going to purchase at $150,000, your rehab's $50,000, and you have an ARV of $250,000, you know that you've put in $200,000 into that property. So just keep those four figures in mind as we work through this. So step one, of course, is finding the property to purchase. The most important thing in my mind when you're looking for that property is working backwards through the numbers to understand what it needs to look like to qualify for your hard money loan and then ultimately to be a successful buy and hold. Not all properties are going to be the right project for a BRRRR strategy, the same way that some properties make more sense to flip versus hold. So understanding what you're shopping for, surrounding yourself with experts, tuning into webinars like this to educate yourself for all things you want to do when you're looking at a different real estate strategy. So again, today we're going to be focusing on the numbers as they would pertain to an actual buy and hold. However, FlipCo obviously does lend on properties where the exit strategy is a straight flip. The quote would look the same. The terms and underwriting on our end as the lender would be the same as well, just to keep that in mind. So again, we are asset-based. So the first thing we're going to be looking to is to make sure that the property that's being purchased is being purchased at a fair market value, so the borrower is not overpaying for the property on that initial purchase. Then we're going to be taking a look at the rehab budget. We want to make sure that whatever work or value add that's going into the property makes sense for the current condition. And then ultimately, will those rehab components or fix up components get you to the ARV or after repair value that you need on that property? And does that make it a comparable to the other properties that we're using to underwrite it? The important piece here as well is in taking into consideration that you plan to hold this property, you might want to look at your rehab budget or strategy a little bit differently. So if on day one, your roof is okay, but not amazing, this would be the time to look at making those capital expenses if you plan on holding the property anyways. So again, we'll walk you through that thought process. Same thing is, in terms of the finishes that you plan to put in. If the fix and flip market would demand quartz countertops, but the rentals that you're using as comparables all have laminate, then we would expect to see a like-for-like finish in the kitchens or bathrooms. We'll walk you through that, but we are expecting you to have some wherewithal to be thinking critically about that piece. When qualifying for FlipCo, go ahead.
I do want to kind of elaborate on, kind of your aspect of finishes of, you mentioned a roof and, say that in order to reach an ARV that you're needing in your certain area, they do have quartz finishes. They do have, certain other high-end finishes, but then you also have a market in that area that has those laminate finishes, the lower grade finishes, and keeping in mind that you are going into a rental and you do need a new roof, you can kind of cut back to add value in certain aspects. You could still get the new roof plus, the lower grade finishes that still make the property look great and hit it into a certain market that still ends up working in the long haul as well.
Absolutely. That's a good point. And I think on a bigger picture, a lot of our investors do say at the acquisition phase that they're not sure exactly what their exit strategy is. I want to say that's okay. Even for myself, when I've invested in the past, I've always said I want to see that there's at least two paths of exiting a property that would still make sense. It's fine to have a favorite, but you never know if a market's going to shift or one way or the other where you may have to hold it or you may still want to flip it. So taking all of those things into consideration, again, we don't expect our investors to have all those answers, but surrounding themselves with people that do, having a really strong realtor who understands the markets and understands investors is critical at that point. And you're right, Ashley. I mean, there's a property I flipped recently right across the street from our office. And I had my realtor actively helping me out in terms of picking finishes so that it made sense for what my exit strategy was, because it was an area that had rentals, but also flips that we were using as comparables. So it's a very good point. Again, so when you're going through your FlipCo pre-approval, we are going to be looking at the asset first and foremost, along with the rehab budget to make sure that that makes sense from an asset-based lending perspective. On top of that, we are going to look to the borrower and their liquidity specifically to make sure that they're in a position to successfully exit this project. We like to explain to people that we are partners in these projects with you. FlipCo Financial especially is a balance sheet lender, which means that we hold all of these loans on our portfolio through the longevity of the entire loan. So in certain instances, other lenders actually sell these loans off and are not with you through the whole process. We service the loan in-house. That's everything from rehab draws, extensions, all the way through payoff. So we want to make sure that the borrowers have every tool that they need, and we've set them up for success. So one of those components is taking a look at your liquidity. We want to make sure that you have adequate funds to carry the project for at least 6 months to get your rehab started, and that you have enough cash to close as well. When we're talking about getting your rehab started, let me unpack that a little bit. That piece is where we will reimburse you 100% of your rehab. So you're going to be getting that capital back, but we only reimburse, right? So we want to make sure that you're able to get your crew going and started, and then you would make rehab draws with us. I do define cash to close up here as your down payment, your per diem interest, and your origination fee. You can see all of that on the quote as well, broken out. Again, super transparent and easy to follow. The most important part here, as it'll pertain to the DSCR exit, is what ARV we're underwriting to. So FlipCo Financial is pretty aggressive that we do lend up to 75% of the eventual ARV. And this comes into play because your DSCR loan will only fund up to a specific amount of that total loan value or total property value. So Ashley will walk you through what that looks like, but taking that into consideration, if a lender is willing to lend up to 90% of the ARV, then that is going to impact you on the exit. Same thing goes for if this is more conservative at 60%, let's say, you may see more cash out on the DSCR side of this.
Hey, Kayla, Zoe wants to know, does she have to have good credit for that, or does our team just go for asset-based and stuff?
Okay, so that's a great question. On this, if we were talking just the hard money side of this, FlipCo Financial does not check credit. It is just asset-based, as you're alluding to and as I've mentioned. However, when you see, I'm going to hand it over to Ashley shortly. She'll go through those qualifications, and the DSCR product does have credit score requirements. And of course, Ashley, you can elaborate on what that looks like. But if you are looking at just doing a flip with us where you're going to get in and then sell the property afterwards, no, we do not have a minimum. We don't even pull credit or report to any credit bureaus. So no. Any other questions yet? I don't see them popping up on my side. So if there's questions, interrupt me, Ashley.
Okay, you got it.
Anything else? All right. So you've bought your property, you have your hard money loan, and now your rehab is finished. You're ready to move into your DSCR product. And then you call Ashley for this part.
So this is where I come into play. As we all I'll just retouch. This is my specialty. I was on the back end of these. Now I'm on the front end of these, and it's a whole lot of fun and a whole lot of information. So I'm going to try and run through it as quick and slow as possible. I know it's kind of hard. So there's different pros that come with a DSCR loan. And a DSCR loan is a debt service coverage ratio loan. So pretty much we'll put you on a scale. We'll take all of your property expenses and put them into an equation to figure out, do you have a negative investment or do you have a positive investment? Anything over a 1.0 is a positive investment. You're making money. You're doing great. You're right on track, to recoup these funds, after within your 30-year property loan to be able to put back into your portfolio. If you have anything under a 1.0, it's not exactly bad, but you're not doing yourself any services, keeping your rental income at what you are versus what you're putting into the property every single month. So the pros of having a DSCR property is that it aligns with a long-term portfolio building strategy. So you've got somebody else that's paying your expenses, but you have a liquid asset. It provides you a passive income from the cash flow. It provides long-term appreciation of the property value, fewer tax implications versus the sale of the property and having to pay capital gains after you finish a flip. You just have all this equity built into this property that you can actually use to your advantage when you refinance. You can pull cash out of it, get more fix and flip properties or fix to hold properties. It's just an overall positive and a pro to taking part in this type of lending. Some of the cons is you don't see the immediate access to the entire amount of forced appreciation after your flip. That is something that you do have to wait for, but still have access to. It's not just immediate. It does take longer to realize your profitable return, and the property management is not for everyone. Sometimes, you really like to be hands-on, you like to be involved with your runners, and then sometimes people just don't want to mess with it. And at the end of the day, that is perfectly fine, and that is okay. Kayla, we can go to the next one. Okay, so some of the options that we do have with the DSCR, you can purchase straight into the DSCR, which is not what we're talking about today. Always use our fix and flip, because if you have a distressed property, it is always better to go ahead and fix it up to get amount of value from this property as possible. Then you have a rate and term refi. So this is, say, we have our numbers. We're $2,000 into a property that is worth $250,000 after the rehab. If your payoff is still that $2,000, let's say you didn't make a payoff, a payment at all, and you still owe $200,000 on that property, you are not going to be able to cash out on this property after some of the fees and stuff that go into having that property and that loan paid off to be able to pull equity out of the property. You would just be refinancing out of FlipCo's initial loan to get the property and rehab it. So then we go into a cash out to say, you rehab this property, you made your payments on a $250,000 assessed property. You're only, say, $100,000 in. That's $150,000 of equity that you can cash out to put into your next flip. So there's different kind of qualifications that we have that specialize whether you can get a rate and term loan or you can get a cash out loan. For our rate and terms, we go up to 80% LTV on the property. So we will loan up to 80% of the loan to value of the appraised value of the property. We do have specific guidelines. So your property has to be valued at least $100,000. So that would make your minimum loan amount at $75,000. So you would be, I'm sorry, I got distracted by one of the comments. Okay, so got a DSCR loan, 50% down last month and almost done remodeling the duplex in California in another 2 weeks. Rate is dropping. Wondering what are your rates for refinance on a lower rate in month to come. So right now our starting rate is at 6.75. But I did actually just get a call and I did not touch up the presentation. Our base rate has now dropped to 6.25. So we dropped a whole half a point today. And that's just because we were competitive in the market and we overcompensated for this drop. So when everybody else is raising their rates, we're actually able to drop our rates. Mm-hmm. So that's just a benefit about us. So going kind of back into the leverages that we do offer, minimum loan amount on a property is $75,000, and that's easy to achieve when you have a property that is worth $100,000. Our maximum loan amount currently on single family residence is going to be $2 million. Anything above that we will not lend on, but we could lend at the max of $2 million. If you have a 2 to 4 unit building, it is $3 million. So that's just always something to kind of keep in mind if you're going to go ahead and refinance with us. And I know on the FlipCo loan side, our max loan amount is $1 million. So that's typically easily achieved when you're refinancing out of one of our loans into a DSCR. The loan terms that we do offer, we have a 30-year fixed rate and term. If you're unsure of which direction the market's going to go, just like with our question from Ms. K of rates dropping and stuff like that, we do offer a 10 and 20-year interest only option. So if you think that the rates are going to go down and you want to do just interest only until the rates hit and you refinance it to a 30-year, that is always an option to do. When you get into these loans, typically they do have a prepayment penalty. So the standard is going to be a 5-year tier. So it'll go 5, 4, 3, 2, 1. After the 5th year, you can pay it off, no penalty, and have no issues. Or they do offer a 3-year tiered. So it's a 3, 2, 1. And for the 3-year, it is just a little slight adjustment to the rate. But that is always a good option to go ahead and take if you think that the rates are going to drop and you want to refinance in 3 years to grab one of those lower rates on a longer term loan. So we kind of went over the rates already. So if we want to move on to the next slide. Okay, so some of the qualifications, and this is where we get into the nitty gritty of everything. Kayla did discuss when you are looking at a property that you are going to rehab, there are some things that we do not require at FlipCo for the fix and flip properties that we do require for DSCR. Unfortunately, you're not going to be able to get into a DSCR loan without having your credit looked at. This is a requirement just because it is a higher risk loan. It is longer term, so that is something that we do need to see. However, we are for investor, by investor. So we actually have a DSCR product that does a soft pull on your credit, because I know as avid flippers, having your credit pulled every time you want to refinance out of one of your flips, that does take a hit to your credit. And we just absolutely don't want to deny you because you have all these hard hits from building your portfolio. So we do soft pull on your credit. So the minimum FICO that we do require is going to be a 660. And I will tell you, if you are one of those people that, pays their payments on time, but it doesn't kind of reflect on your payment or on your credit score, what you can do is you can actually pay towards your credit by your statement date, not your due date. And that will actually help your credit go up and reflect the good borrower that you are on paper. Because pretty much with a story with Fix and Flip, we can talk directly to the borrower, and it doesn't really tell us, a storyline when we're looking at paper on DSCR. So telling a story on paper is a lot better. Doing like these little tips and tricks as well that you can get from talking to financial advisors and, your loan officers and stuff like that. We have a couple
I want to just mention there what we've also seen in the past is if somebody's expressing to us at the time of acquisition that they plan to do a DSCR, we will discuss credit with them because, we're not going to necessarily pull it. Again, we can do a soft pull even at that time. But if we know that their credit as it sits on day one wouldn't qualify them, we can get them in touch with credit repair agencies or provide them with those resources. Because sometimes if they're just slightly off the mark, you have to remember there's going to be time before they have to qualify for the DSCR product. So if you're worried about your credit today, it doesn't mean that you shouldn't be exploring these options, because you would still have time to, call it 6 to 8 months, depending on the extent of your rehab, to be repairing your credit while you're repairing your house.
So, we have a question. DSCR single family usually do 15% down rate. It really just kind of depends on what product you're going after. If you're looking for cash out refinance, it is typically a minimum, depending on what your credit is, as we're discussing it, 25% down. So the max that they'll give is going to be 75% LTV. And if it is a rate and term, a lot of times it is 20% down. So it just really kind of depends on what you're trying to do when you're looking for your percent down. And then it's also kind of your qualifications that go behind you. Standard is, we have tiers of, if your credit is a 660, you may not qualify for the max allotted amount. If you have 680, you do, but the rate is going to be adjusted off of that as well. Edwin, Houston, Texas. Call me, please, after this webinar. You can email anybody or call up to FlipCo Financial through our website at flipcofinancial.com if you need to talk to somebody now, or if you want to call and leave a message for us to be able to contact you afterwards.
Yeah, we have our contact info at the, I think our Q&A slide has all of our contact info there as well. I want to touch on that question about the down payment though. So in an ideal scenario, if you're getting your loan upfront with FlipCo, our minimum down payment is 10%. We do 10% deals all the time. It does rely specifically on what the loan to value is of the ARV. So if you're buying the property right, the rehab dollars and cents make sense, and your comparables are getting you to at least a 25% spread, then you're only needing to bring 10% down. When you go, and correct me if I'm wrong, Ashley, but my understanding is that when you go to refi, again, the DSCR piece is looking at the current value of the property. So it doesn't necessarily mean that you'll have to bring the difference to the table if that loan to value ratio is already at 75%. Is that right?
Correct. So it's not a guaranteed of, you're always bringing, 25% to the closing table or, 20% to the closing table. It depends on how much equity you do have rolled into the property. Okay. And that can offset what your down payment is going to be as well. And typically you won't have the final down payment until the end of evaluation because, your titles have fees, your appraisals have fees and stuff like that, because that is something that we do require when you're working on a DSCR loan is we have to have an AMC appraised appraisal come through supporting the value of the property. So FlipCo, we do in-house evaluations. We do not require appraisals on our fix and flip properties. However, our DSCR, we do require them.
I think the next slide will show that example and it might be easier to explain that.
Yeah, so I'll just kind of quickly run through of like some of our qualifications and requirements that you need to keep in mind whenever you are looking at a property to go ahead and buy to flip and hold into a DSCR for the BRRRR method. So you need to make sure your DSCR covers a 1.0. So you're going to try and take into the calculation of when you're buying this property for $150,000, you're putting $50,000 in. What does your payment every month look like? How much could you charge in rent afterwards of for this property for someone to live in? That's going to cover your hazard insurance, any HOA fees that, you know, might be involved with the property and its location, your taxes that you're going to pay annually, and then of course your mortgage. So you have to cover your PITI, and we always like to make sure that's positive, that's good. You're getting, you know, your monthly income on top of, you know, your mortgage paid for and all the other bills that are associated with the property. So that'll put us above a 1.0, and that will also give you a better rate. Anything below a 1.0 is not something that we will actually finance ourselves. With a DSCR loan, we do require it to close in an entity, and that's not just for us, that's also to protect our borrowers in case anything is to ever happen, you know, with your tenant or anything like that. The property is owned in the entity, so you as a person are protected. Going back to credit, we do require a minimum of 3 trade lines. 2 do have to be active, and 1 has to be open for at least 24 months. So if you do not have credit that is open for 24 months, but you've got, you know, 18 months, we can take a utility bill that you've paid for a couple months to make up the remainder of that 24 months. So there are some options if you don't have the all the requirements for the credit. We also do not allow any mortgage lates at all. No 30 days, no 60 days, or anything, because going back to, we are telling a story on paper. And when it comes to COVID, that is a little bit different story. So we don't like to see any lates within the last 2 years. So that's a positive. They will ask when it comes to credit with COVID, kind of just for a letter of explanation to kind of explain what happened, because again, we do like the story on paper. We do not do owner occupied properties. So if you fix up a property and you decide to live in the property before, you know, you turn it into a DSCR, that is not something that we will be able to refinance you out of. We also do not refinance if you have family living in the fix and flip property. So say that, you know, you were trying to help out a family, they moved in for a couple months, and the appraiser came and it was marked owner occupied during that time. That will cause a hiccup, and we will not be able to refinance out of that property.
Actually, if the family member is in fact your tenant, will that still come under scrutiny if you have a signed lease agreement with them? Or is that fine?
Because a lot of times when you lease to a family member, you can work out different options to make your monthly rent payments, and that we don't ever want to put you in a position to where the family member takes advantage of you and doesn't pay the monthly rent, and now you're not receiving that income. So that is something that we do actually not lend on.
Okay.
Some of the documentation that you're going to have to think about whenever you are prepping a DSCR loan is, obviously, we're going to need your ID. And something that I find often that stops a DSCR loan is if your driver's license ID matches the property address that we are refinancing. That's a big we don't do owner refinances. So that's just something to keep in mind, that if you have to get that changed before we refinance, know that in the beginning. The property application, we'll do a credit authorization so we can soft pull all of your entity paperwork. We'll need 1 month of proof of funds for the paid appraisal invoice, your insurance, because I do want to look at your insurance and make sure that you have something called rent loss on the insurance. So we ask for 6 months. So if we do ever in the future run into another situation or scenario like COVID, where the government allows your tenants to not pay you for a certain amount of time, you can actually go back to your insurance, and your insurance will give you 6 months of the rental income that you would have made had the tenant actually been paying. And that is something that we like our borrowers to cover themselves on just in case. And then we will need the signed lease of the tenants that you are moving in, and then the HUD from the original purchase, which FlipCo will already have. So we will be able to supply that easier. And then the payoff, which FlipCo can also get as well. When it comes to final approval, we will want to know what title company you like working with. If you need suggestions, we can absolutely give them to you. If you do have an HOA, we will need documentation with the HOA on their fees. And then, of course, that appraisal back, fingers crossed, it exceeded our expectations after our flip was completed.
Ashley, we did have one question while you were working through that from Kay. She was asking if an owner could live in one of the units for a multi. So if somebody was going to do a house hack, if everyone's familiar with that, is that something that could qualify for DSCR?
So, I mean, yes, but when it comes to the DSCR equation of, all of the leases from across the multi-unit. So if you have a 4-unit property, you have a family member that lives in one of the units, we would only use the leases from 3 of the properties to qualify what the DSCR is, because, just like I stated before, if some alternative, type of rent was worked out, payment was worked out, you wouldn't be getting that. So we want to make sure you're still in the positive after only using 3 of the actual leased units to non-family members.
Got it.
Cool. So these are some of the numbers that we were talking about earlier when Kayla said that we were going to reference back to. So, you've got your purchase price of $150,000. You put $50,000 into the property. The ARV is now $250,000. So I'm going to take you from the right side, and then I'm also going to explain the left side. So we're going to start where it says value. Value at $250,000. If we scoot over to the left, it has the LTV. So we want 75%, say cash out. Say we're going for a cash out loan. If we want 75% of the property, because that's the max allotted, that only brings our loan amount to $187,500. After our estimated payment at the rate of 6.75, and your insurance, and these are monthly expenses, your taxes, we don't live in an HOA, we're only charging $2,000 for the property to be leased. After the admin fee, the processing fee, and the appraisal, you've got a DSCR of 1.29, and this actually turns into our a rate and term finance. So say our property came in at $275. This would turn into a cash out property, because in the first scenario, we're having to bring $4,000 to the closing table. The second scenario, at the value of $275, we'd actually be getting cash back from the property with the equity that we put into it. So when we talk about some of the finishes that you put into it, you do have a higher value when you use granite over laminate, when you use certain floorings, hardwood floor over carpet, or hardwood floor over tile, or you redo a shower with, instead of just the inserts, you tile it, you get extra value from all of those things. So if you are aiming to hit a cash out property with a scenario like this, with the same $150,000, $50,000 rehab, but you want $275 instead of $250. Those are types of finishes that can make or break your cash out deal at the end of it, that you do need to be considerate of when you're working and rehabbing a property.
Perfect.
Okay, so kind of how FlipCo would go about doing, your DSCR loan. We would go ahead and run your pre-approval. So at 30 days of maturity, we have a lovely lady. I'm going to go ahead and name her. Her name is Iris. She handles all of our maturity things right now. She'll reach out to you. She'll send you a polite email that says, hey, we're 30 days away from your maturity. What outlet are you thinking of doing? Are you going to go ahead and pay this off and sell this? Or are you considering DSCR? If you come back and consider DSCR, I'm going to come back and ask you, what's your estimated FICO? What are you seeing any preliminary interest from everybody? What are you thinking of charging monthly? What are your estimated property taxes now that, your property is going to be reevaluated? What's your estimated insurance premium, since we're adding that 6 months of rent loss coverage into it? Do you live in an HOA? Are you located in a flood zone? Because flood insurance is expensive. So we want to make sure that we are charging enough in rent to cover flood insurance, because that will make or break a 1.0 DSCR to under a 1.0. And then have you done your research on what your average cost of rents are in the area if there are other rentals? Because if you have a 3-2, say 1,500 square feet, and you have the exact property and one's charging, let's say $2,000 a month, but you want to charge, $3,100 just to meet your DSCR, a lot of people are going to choose the less rent over the higher valued rent. So you kind of want to make sure that it's lining up in the market that you're in so that you can get this leased and you can get refinanced out of the fix and flip loan. I'm going to obtain kind of your preliminary terms that are contingent on the property or the provided information. And I'm going to get you a pre-approval from our underwriting of, hey, we're looking at this rate right now. We're looking at this loan to value on it. Here's kind of your couple options. Which one do you want to go with? And then I would go ahead and full steam head into the refinance process. So if you want to go to the next slide. So I would grab your documentation that we kind of covered earlier in the slides, your ID, the application, the credit authorization. Hopefully we worked on our credit, we're good to go. We're in the clear. If that was needed, all of your entity documents, proof of funds. So I will need 1 month bank statement just to make sure our minimum reserves are covered. So typically DSCR loans, they do ask of 6 months minimum reserves covered, just because, and escrow payments, just because they want to make sure that on the back end, the borrower is always taken care of and nothing surprises them, because we do deal with a lot of people who have portfolios of 50 to 100 properties, and sometimes payments can just slip away with you. And we want to make sure that's not something that happens. So we do escrow a couple payments for you.
I have a question on that one, Ashley. So if we're anticipating that the ARV is going to come in really healthy, and a borrower is relying on the cash out component for their proof of funds, is that something that would work? If you know that there's going to be $50,000 of cash out, can that be held back in escrow instead?
So we do allow 50% of your cash out proceeds to cover some of your reserves minimum. So we're still giving you that cash, but we're also taking that into account of, okay, this is going to be deposited in your bank account. You just can't see it right now because it's in, so sorry, I'm getting a call. This is, in the property that you currently have. So we'll use 50% of it, but we need to see that you can also make 50% of those payments as well before getting the cash out.
Got it.
Cool. DSCR specialist introduction. Well, hi, that's me. You guys are all introduced. So let's get past that part. Can you hear the ringing on that end?
Yeah.
Okay. Well,
There we go.
So sorry, guys. So package polishing, I'll go ahead and get all the documentation that you sent me. I'll review it with a microscope just to make sure I'm catching anything before underwriting gets it, because I'd love to, submit a clear and concise package so that there's no questions, that there's nothing that could snag us, especially since you'll be paying off FlipCo's loan. FlipCo wants to make sure that this is all beautiful, seamless, that you have, a 4 to 5 day closing, because, with FlipCo, you can close pretty fast. I'd like to be able to do the same thing with the DSCR with FlipCo and everything like that. They may come back with some conditions. We'll just have to be prompt with filling those conditions. So something that I run into is, which isn't so bad, but FlipCo does offer bridge products, bridge that doesn't always require rehab, or so, our borrowers think. But however, with DSCR, they want all rent ready conditioned properties. So if you have a hole in the wall, that has to be fixed prior to closing on the loan. If you've got shingles missing on the roof, well, that could lead to a potential leak in your roof that's going to have to be fixed. Your tenants would have to move out for that to be done. We want these all things to be avoided, and we don't want your tenants to be disturbed and then not making their rent payments. So everything has to be in rent ready condition to be able to close on the property. So we want to make sure that we achieve an as is appraisal whenever the appraisal is done, rather than a subject to appraisal, because that does cause delays. So once everything's good to go, we're in the clear, we fund your DSCR, and you've either cashed out or you've paid off FlipCo's fix and flip, and you're one step closer to building your, portfolio of all the rental properties that will be paying all of your bills. Woohoo! Congratulations, you funded. You're now a top tier DSCR specialist.
And then you repeat. That's the whole idea, right? I did have one more question before we hand it over real quickly. So you mentioned that FlipCo does have a bridge product that obviously we know about. Generally speaking, when we see somebody coming to FlipCo to use a bridge loan versus a fix and flip loan, it is almost always because they want the access to capital quickly so that they can be competitive on the market. Obviously, they expect there to be an exchange of a discounted rate, or a discounted purchase price rather, if they can go make an offer on or off market saying, hey, I'm able to close this, cash deal in 5 days. Can I purchase this property for $200,000 when maybe, it would have been worth $225,000? So if a borrower uses FlipCo funds under those circumstances and the property is already rent ready, as you mentioned, is important, is there a seasoning period for the DSCR loan refinance process to start?
So there is. If you want to use maximum value, so okay, say you bought a property that is undervalued, perfect with bridge, but the appraisal comes in at a higher value. If it's less than 3 months, we go off of the actual purchase price of the property because it's not fairly seasoned, so you don't get that automatic equity. If you wait for the 3 months to hit, they will go off the evaluation of the property. Now, a cash out in between 3 and 6 months, that's up to underwriter discretion. Just, did you get a steal of a deal, or did you force this appreciation way too much to try to pull the cash out of it? And then after 6 months, you're absolutely in the clear. There's no questions asked. It's just the repair value and the as is that's on the appraisal.
Great. Okay.
I have another really good question for you. Yeah. Melody asked, the interest rates back on crazy track again, and the rents in my area, Orange County, did not do well. I'm considering out-of-state options, but also want to ask, how do I manage from afar? Should I focus on rent-ready homes or value-added ones?
I can share my 2 cents, and I probably have a similar perspective. As mentioned at the beginning of the session, I'm actually from Canada. I've been in Texas now for about 5 years, but we had a portfolio of properties in Canada when we moved here. We did have a property management company that we owned, so we just kept that up and running, servicing ourselves and our clients while we were gone. But I would say having experts in those markets is going to be the make or break for you. Having people that you can trust when they're giving you feedback, whether that's a realtor, a contractor, a property manager. And those people are definitely worth their fees if you're planning on investing in other markets. I wouldn't say that there's a right answer one way or the other in terms of focusing on something rent ready versus a value add. It really will all come down to who you have on your team. Obviously, the easier play is just picking something up that's rent ready and popping a tenant in there. But you're going to see more appreciation, potential cash out opportunities if you do a value add play. And I would say that in addition to that, thinking about how accessible the location is for you, how close it is to a major metro airport, for example, is really important. As we've changed locations that we lend, and we lend actively across 7 different states right now, we have looked to see if we can get there easily if we need to. We don't have boots on the ground everywhere we lend, but I want to feel good about saying, hey, if something is going awry in a certain state or a certain city, can myself or one of our team members get on a plane and go there? And if it was my own money or a property I owned myself in, Cincinnati, Ohio, I want to make sure I can get there to check on it if I can't rely on the team that I have there.
So something that I kind of do want to add on top of that is, if you do a flip in an area that you do not reside in or have boots on the ground in, there's something that you have to look into, which a property management company to handle the tenants that you would put into the property, and then to take into account. So typically a property management company will charge you 1% of whatever you're charging for the lease. So that's an additional item that you have to be cognitive of whenever you're charging lease, to make sure that your lease amount does still cover your mortgage and all expenses, to have a positive investment going into that as well. So I do have personally a lot of borrowers that reside here in Texas, but have, Section 8 housing that is managed and paid for in Georgia and Pennsylvania and places like those. So it is possible. It's just, how much faith are you willing to put into a group to manage, your projects and your investments, if you don't have boots on the ground or don't have easily access to get there often to look at the property. I don't know if I'm a micromanager, but I like to lay eyes on properties at least once a month. So it's just really what you're comfortable with.
I found the questions. One of them that I think is great for you to address, Ashley, says, are there any leases that have to be in place with the refinance?
So any refinance that you have do need to have leases in place. They don't have to be residing within the structure or the property, but they do have to be lined up to be moved in. So there is something we would have to see, the signed lease, first month payment, and security deposit, saying that the tenant is absolutely ready to move in. They've paid their money. They're willing to go. It's not just, a faulty lease that is being provided just to get the refinance done.
Okay. And then how would we approach that for a short-term or a midterm rental? Does DSCR apply to those strategies?
So with us, we don't do midterm. We do more of a short-term rental income. So if it's been a short-term rental property, we can qualify off the lowest income from the past 12 months. So the lowest income month is what we would qualify the property off, or it has to debt service off of, the 1007 that we receive on the appraisal. So It's just the normal market rent, as if it would have been, a leased property for a year. It would have to debt service off of that.
Okay. So then in that instance, we would be able to use the 1007 from the appraised rental value, even though there is an assigned lease to support that.
Correct.
Got it.
Correct. So with it being a short-term property. Yeah.
Okay.
What is your hot take for the Florida market with the 2 recent big hurricanes? Are you lending there? Will you continue to rent there? What do you think will happen for investors looking at investing in Florida? Ooh, can I answer part of this one?
I'll kind of share high level, and then I'm sure Ashley will have something to add to it. We are, as of this exact moment, not lending in Florida today, but we intend to continue to lend there in the foreseeable future. Right now, we have Monday slated as the date that we'll start opening that market back up. The biggest thing for us is just making sure that we have current updated photos and videos of the properties. We have about 75 active loans in the areas that were impacted by the 2 most recent storms. So we're working closely with our investors there in trying to make sure that they can still get through their projects successfully. I mean, look, we live in Houston. We are not naive to the risks that investors and lenders are taking in these markets, but we are also pretty bullish on how these markets are able to recover post-storm. And then the other piece of that is asking about what we're anticipating for investors in these areas. Realistically speaking, in most of these really hard hit areas, we have seen investors flock there after the fact. And it sounds a little bit gross to think of the opportunities that are on the other side of these really tragic weather events. But the reality is that we cater to investors who are buying distressed properties. Well, what's one way to find a lot of distressed properties? Going to a market that's been hit with a storm that's caused properties to become distressed. The housing shortage in states like Texas and Florida will continue to drive the need for these properties to be rebuilt or rehabbed and then put back up onto the market as rentals or as resale properties. So we will be there. We're still very bullish on markets that have been hit recently. We are also very active in North and South Carolina that was recently impacted, and we're still funding deals there right now, even post-storm.
Yep. And I mean, I will say that, the Florida area is always a high end area that people look out for, rental wise, investment wise. It is just very popular. And unfortunately, natural disasters just make that, more of a plausible area for, maximum investments. So continuing to lend there. It would be a mistake to not, which I don't think that'll ever happen just because of the area and the income that's there.
Right. I agree. I mean, yeah, it will always be in high demand. I can't imagine what it would look like for states like Texas or Florida to not be high demand real estate areas. Another question we had is how to make sure, in my opinion, or IMO, is budgeting enough for a rehab? Should I estimate like 5 to 10 buffer around the rehab? Very high level answer for that. Absolutely. I mean, if there's one thing that is certain when you're getting into a fix and flip property is that you will have surprises. I've been at this for over 10 years now. I've touched just about every exit strategy you can think of. I have had crazy things happen during renovations, value adds. I've had a property burnt down by a tenant. Like that was probably the wildest thing that happened. But we, one thing, like I said, we can guarantee is that there will always be surprises. Worst case scenario, you have a contingency line on your budget that you don't use. One of the cool things with FlipCo is that we do only charge interest on funds used and not committed. So what that means is that if you tell us that you need $60,000 for your rehab budget and you turn around and find cheaper labor or, lesser priced products, whatever, and you don't use that full amount, you're never getting charged interest on that $60,000 rehab. So it's always better to prepare for the worst and then, hope for the best when you're working through your project.
Here's one for you. Which market's best if I looked out for low entry prices and high rents?
So this is not something I can speak on super specifically, but I am a podcast and newsletter junkie. So if you're following any of those trends, I would say the, sort of like Midwest area, those more sleepy towns seem to be super, super hot in terms of getting in at that lower price. On the contrary to what we were saying about Texas, Florida, I mean, those sorts of that Sunbelt area, that's on everybody's radar. They're considered the more like volatile but sexy markets to be investing in. If you start to look in places like Ohio, where it's just been a very slow and steady pace, we recently started lending there for that reason. It just seemed to be a super stable market. We haven't seen huge boom or bust kind of numbers. And so as an investor, that would make me think that if I'm looking for a long-term play, it's just like buying a stock that's steadily growing instead of, that hockey stick hyperbole, which you can see come down on the other side really quickly. So I would say looking for those sleepier states or cities is where I would be leaning in if I want a low entry point for a purchase, but reliable income as a rental.
Yeah. No, I mean, it's something I agree with is, a lot of people in today's society, the younger crowds, they are not maximizing kind of their income to be able to go ahead and purchase houses, kind of like we did as, we were younger and stuff like that. So the rental market, as it always increases, even if the buying market, it fluctuates, rent is always going to go up. So something you should also look at is potentially looking in an area that just came out of, a declined area and it's starting to come up. You're going to get on that lower end and it's going to increase as you go on as well.
That's a good point. Yeah. Taking a look at, even a 10 to 20 year cycle in certain areas. I mean, everything in real estate is cyclical. So that's a good idea. I think we went through, here's a new one. If you don't know how to find and close your deals within 3 months, join our experts. Okay. Is there anything else coming through? Any other questions that y'all wanted?
I've got one. I think you mentioned this earlier, but I'm not sure. Like low credit can actually get better refinance, right? Because we got that better interest rates cash buyer here. So we actually do prefer to have higher credit. Because it will get you better interest rates, better loan to value on properties. However, we do have, strategic ways that we can help, your credit do look better if you do avid flips, or, you do a lot of stuff with cash or anything like that. Just because if your credit's low due to lack of credit or for any reason like that, we do suggest getting with a financial advisor. We can help you if you're preparing, flips to go to rentals, anything like that. But the higher your credit is, the more LTV that you'll be allotted with a refinance, and the more money that you'll kind of get out of your property.
Okay. And then go ahead.
My goal is always to try and get as much of a down payment and credit card back in my back in my pocket. Should I go with rent ready midterm way? Yes and no. I think that you'll actually get more back in your pocket if you were to buy, distressed properties and then rehab them, because you're in for it less than what you're getting out of it. So it's the best way to put money in equity kind of back into, your projects and cash out on those. Because, when you get into a fix and flip, your rate is based on the risk that's in the market. And unfortunately, fix and flip companies do have more of a risk than, long-term DSCR companies. And so, or like loan profiles. So, your rate is going to go down after you complete your flip, and you're going to have all that equity put into your property. So you'll actually get more bang for your buck doing it that way than buying, a property that is, rent ready because somebody else has put in the time and, made that property good, that they're trying to capitalize on that. So you're actually buying an overpriced kind of property for what your intended outlet is. Okay. Able to get the recording. Will I be able to get a recording of this presentation? Okay. I think
there's one more that came in toward the end asking about pitfalls watching up for when investing in non-turnkey BRRRR properties. I think there's two pieces to this, and Ashley touched on it a little bit. If you're buying a property that's already rent ready, in one way, you've kind of skipped over what can be the harder part of having to deal with the value add piece. However, you're not the one who's put the time or money into that property. So you don't actually know what how was the roof installed? What are the mechanics of the property's current age? So to me, that would be a little bit of something to look for if you're buying something that is turnkey, but you don't really know exactly what work has been done. Of course, in buying a non-turnkey BRRRR property, it's all the possible surprises that you may not see until you start opening up walls. So, with anything else where there's greater potential reward, there's usually greater potential risk. But I don't want us to ever be blinded by thinking, well, I walked the house, it looks beautiful, it passed an inspection, so this must mean that it's going to be a perfect rental property if the numbers balance out. So a lot of times you still don't know what's behind those walls or the things that you can't see, right? And so in any instance of getting into being a landlord, just be prepared for the unexpected.
Hey, Kayla, here's one for you. Hey, is it a good idea to buy materials myself? I've heard contractors can sometimes mark up the cost. Should I save some cost by myself or consider some other factors?
So this is an interesting question, because on the flip side, I've often mentioned to especially newer investors that the best partner they can find in a project is a really reliable GC. The GCs that we've worked with projects that we've flipped here within FlipCo or HomeCo, our contractors have access to lower priced materials. And so we generally get to enjoy those savings. It's almost like a perk that they bring to the table where, if they know where they can go and get wholesale pricing for hardwood flooring, that's going to be more affordable than me walking into Floor and Decor, for example. So I've seen both sides of it. Honestly, if you've got a really great GC and they want to supply you with the product and you feel good about what the cost of that flooring, countertop, hardware is, then I would say let them run with that. Maybe they're marking it up a little bit, but if it's comparable to what you would pay at the store anyways, let your GC make that money. You have to think about it from a cost time analysis. Do you want to go shopping everywhere to try and find the best wholesale pricing? That takes time and relationship building. If they're not marking it up and they're picking it up at Home Depot where you could go anyways, I would say working with your GC to source your materials makes the most sense, honestly.
And to kind of elaborate on that, it's, it's learning to trust like who you're allowing to work on your property. You're going to build the relationship. You're not just going to get into this kind of industry and, this investment process and just be like, you know what? I'm going to swing into the air and just like hope something sticks and I make contact with something. You're going to want to do some research. You're going to want to find out, what is the price per square foot if I were to consider this or this? Like, obviously, you're going to want to be a little bit knowledgeable going into, a project like you're flipping a house. So it's not something that you lack knowledge on or this. So you're going to know what your average cost is in that area or things like that. So if you receive an invoice from a general contractor and you're like, whoa, prices must have shot up because of inflation or this, that, or whatever. And you're like, I want to shop around a little bit. It's always positive to get a couple different estimates from people because just like you said, like you've heard of people rolling in some costs. If you feel like somebody's doing that to you, just follow your gut and trust your instinct because at the end of the day, this is your property. This is your investment and you want, to make sure you're making the right decisions. So it's just trusting who you decide to go with your money and your investment.
Agreed, for sure.
I think that's all of our questions.
Yeah, thank you, Kayla and Ashley, for being here and sharing your knowledge here with us. Really appreciate it. Thank you.
Yeah,
It's
absolutely.
a pleasure. Thank you for having us, Steve.
Yeah, absolutely. So for those of you that want to receive a recording of this session, make sure you have registered for the StreamYard and you're going to automatically get a link to the recording. Okay, so we're going to leave this live stream on for a little bit longer after we end, so you have a chance to register for the StreamYard. Another piece is we're going to send out a link shortly to you to get your feedback on the event. We want to know what you think about this class, this event, and also what additional topic you want to learn about from Kayla and Ashley. So make sure you fill that out and we'll have a special prize for you for filling out that survey and giving us feedback. All right, so I think we're gonna end today. Thank you so much, both. And we have our phone number here, so we know how to reach Ashley. So we're gonna end here, and we'll have our next event coming up. The upcoming one is gonna be next Friday, actually this Friday. So tomorrow at 9:30, where we'll talk about how to close and win deals. If you're interested in that, we'll be sending you a link. So just use the comments here to share with us, what your thoughts are and all that. All right. Have a great day, everybody.
Thanks everyone.
Have a good Thursday.